Good day, everyone. This is Patrick from EasyFX Code Trading System, and it's Saturday, the 12th of November, 2022, and this is the weekly technical analysis for spot gold and dollar yen for the third week of November. And you'll see spot gold has really shot up at the expense of the US dollar, so that's why the dollar against Japanese yen has fallen hard as well. And that's all due to Thursday's US CPI data, which came out slightly lower than expected. And this triggered a boost to the stock market, bond and futures market, and weakness in the US dollar, with the expectation that the Fed may not increase rate at such a high rate and may slowly taper and reduce the rate to 0.5% in December from an expected 0.75 basis point or 75 basis points. But this is only one snapshot, just one CPI, 1 month's data. It did come out lower than expected, and it may not continue lower, could maybe stabilize around this region. The month-to-month figure was lower by 0.4% versus expectation of 0.6%. And the year-to-year figure was down 7.7% compared to expectation of 7.9%. After hovering above 8% for past few months, from 8.2, 8.3. So just with this optimism, that's why the stock market rallied, and gold has also flew past this trend line on the Thursday to a 500 pip move, just shy of the daily 200 EMA, and continued on Friday with the rest of the week bullish momentum. Dollar yen fell even harder, down 600 pips, and then continued further on Friday. Let's begin with the spot gold, and already from Tuesday, it already broke out above this trend line, right to the 78.6 big retracement, and that was just because of the start of the US midterm elections on Tuesday, pause on a Wednesday, and then that was the big breakout on Thursday. So let's update these resistance zones now. It's we target the next fib area. Let's move this out now. In fact, we can also just update this fib and flip it around to show the reversal, and that's where it hit right on Friday, right to the 138 pip extension, 1772.58. It did hit up high, 2 pips higher, 78. And the 162 extension is a confluence with the next round figure, 1800 round figure. So that's definitely going to be the next key resistance zone, which is already marked here. So let's move this one up to the 1800 as a key resistance zone. The support now will be at the 1700, where it bounced off the trend line at the 78.6. Good retracement, so that's the interim support. We can also move this next key support, but for now, yeah, it's going to be at the 50 pip here. As a key support zone. All right, and there's a number of US news this week with the PPI, retail sales, and the Philly Fed manufacturing index. And we'll see if there's any trigger from these moves, from these news to attempt to target the 162 FIB, 1800. Could be a pullback first at the start of the week to 1750. Or if it's a deeper retracement, then it's back to this swing high near the 1730 area. Okay. And on the weekly time frame, of course, we'll see a very strong bullish move and right into the weekly 55 EMA as well. So could be a reason to pause and take a breather at the start of the week. But yeah, 1800 looks like the next key resistance level with this previous swing high, with the swing high area. Okay, so let's compare this with the US dollar index to see how far the US dollar has fallen. And here's the US dollar index. And as you can see, Thursday, Friday was very bearish, falling all the way down to the 106 round figure, just shy of the 21 FIB retracement and the daily 200 EMA, and started the week dropping below the daily 55 EMA and this swing high area. And tested the support, bounced off the support at the 78.6 FIB and the 109, just to retest the swing high again as resistance now, and then falling hard on Thursday and Friday. So that's over 400 pips from the 110. Now it looks like it's going to target the 105 area. That's the 200 is sitting just above the 105, and the 105 is down here. We'll mark that as key support now. And this 109 area is with this swing low previously at the 78.6, that's going to be resistance. Can move this lower, perhaps down here will be interim resistance at the 108 and the 62 FIB. So we can remove this one now. And below that, of course, there's even more significant support at this swing low. It bounced from all the way from August, just 3 months ago. Okay. So we'll leave the fib as it is for now. We could actually add reversal or continuation bearish setup, but it's okay. We can still use this for now, since this is coming quite close to the support zone. We'll see if it's going to make a pullback first before dipping to test the key support 105, or could be beyond, but we'll see how far it goes with this momentum, or whether it's just going to halt at the 200 for now. And the 200 is at 105.37, so just above the 105 round figure. We add a bearish continuation setup here, and that coincides. It's gone past 162, and the 200 fib is just below the 105 round figure. But for now, we'll leave it out for now. Okay. So those are the key levels to watch out for. And let's move back to the other major pairs. Let's move on to the dollar against the Japanese yen. And after breaking down from this lower trend line of the triangle, on the Tuesday, paused, pullback on the Wednesday, and then after testing the trend line, fell all the way through the support zone, the initial support zone 145, and the daily 55 EMA. So all the way down to the 50 fib retracement area, and could be targeting the 38 fib here. Let's mark this as an interim support. And the next key support will be at the 135, along with the 21 fib, and as well as the daily 200 EMA. We'll bring the interim resistance back down to the 142 area with the 78.6. Resistance. So let's move this out of the way, and this can come down to the 145 as the breakdown area. And on the weekly time frame, that's the very strong bearish candle here, about 900 pips. For now, I think we'll leave the fib as it is. We could also add a bearish continuation move where it went for the 200 fib. And if we take the reversal move, and it's going to try to target the 136 area. But for now, we'll leave it as it is, use the current fib levels. Okay. So it was basically about time for the US dollar to retrace, and that was the trigger for that. That was the only opportunity for it to drop with the slightly lower inflation figure. But we'll see how long that's going to last, and next month will be another figure to watch out for, and along with the Federal Reserve meeting again. Okay, do check out my other videos on the other major pairs. Have a safe week and a good trading week, and cheers for now.